Welcome back. Now, it's been a mixed bag of data points for Kenya. The inflation trajectory is moving in the right direction. The latest reading for December at 6.6% from 6.8% previously, while third quarter GDP outpaced analyst expectations at 5.9% as agriculture helped spur growth. On the downside, however, business confidence is deteriorating as the shilling remains under pressure while big rate hikes are used to remedy the situation. Shani Smit-Lengton, who's economist at Oxford Economics Africa, joins us for a greater perspective on these data points and what it suggests for the East African nation. Shani, thank you so much for being with us today.
Thank you for having me on your show.
Fantastic. Let's talk about the direction that you think interest rates will move there in Kenya, considering that the next MPC is coming up.
All right, so we expect monetary authorities to hold the benchmark interest rate unchanged at 12.5% at its next meeting in February. This is because we expect inflation to ease further in January and for the Kenyan shilling to find some stability. I know that there are some analysts who are betting on a rate hike in February due to the recent depreciation of the Kenyan shilling, but I can't see the central bank playing this card again. I say this because the central bank hiked its interest rates to a decade high last month to try to support the Kenyan shilling, but the shilling has just continued to depreciate since then. In fact, the shilling has depreciated at a faster rate compared to previous months since the rate hike in December. So the rate hike hasn't really been able to do what it was intended to. Because of this, I think that the central bank will bite the bullet and keep interest rates unchanged in February. Beyond February, I think we could see a rate cut in the second quarter of the year, but this will depend on inflation and the shilling going forward.
Let's speak about that shilling. What has contributed to this depreciation, Shani?
So the shilling has been under notable pressure due to various factors, such as a stronger US dollar, the dollar shortage, also high inflation, and the wide current account deficit. But if I were to narrow it down, I'd say that the main driver of the weaker shilling has been poor liquidity conditions. So I think I have mentioned it on your show before, but Kenya has been struggling with a severe dollar drought over the past 2 years. The situation has gotten to a point where the central bank has ordered commercial banks to ration US dollars. So traders and businesses were limited in the amount of US dollars they could withdraw from commercial banks. When this move didn't necessarily work from the central bank, then the president ordered the revival of the interbank foreign exchange market. Unlike some news agencies' reports or general reports say, this revival hasn't necessarily led to a significant improvement in dollar conditions. So that is why the Kenyan shilling has just continued to slide against the US dollar.
And are we anticipating that there could be any stability for the shilling, anytime soon?
For now, we expect the shilling to gain some ground in the coming weeks due to loan dispersals. So the first loan dispersal is expected to come from the IMF as they met yesterday to discuss the country's reform program as well as unlocking additional funding. But beyond the loan dispersals, I think it is important to recognize that the Kenyan shilling tends to depreciate in the first quarter of every year. This is because the beginning of the year usually sees a dip in liquidity after the festive season, so one can expect a more pronounced movement in the exchange rate. I think markets have just been under more pressure this year. So in a nutshell, I expect the shilling to gain some ground as soon as the IMF disbursement filters through the economy and once markets normalize.
I wanted to speak about the issue of inflation there and just the underlying factors for inflation easing. What are these factors, contributing to inflation in Kenya? And then what are we forecasting for 2024 in terms of that inflation picture?
So we recently reduced our Brent crude price forecast for 2024 due to higher supply and softer demand in the global market. As a result, we have lowered our fuel price inflation forecast in Kenya, as well as our core inflation due to a softer import bill. We also expect food price inflation to ease this year, and this is because of the improvements in the agricultural sector and the adverse weather conditions stemming from the El Nino event hasn't been as severe as we initially anticipated. So the downturn in pump prices as well as food prices is supporting our narrative for inflation to ease to 6.4% this year. So the 6.4% figure is below the central bank's upper target of 7.5%. So this is something to keep in mind when looking at interest rate decisions.
We had an interest rate hike, I think, in December in Kenya. It didn't quite, do what it was intended to do. So what other alternatives does government have here, other than interest rates?
Given that inflation is expected to moderate this year, I think that the main risk is the weak Kenyan shilling. So this essentially boils down to liquidity concerns. I think the government needs to prioritize increasing the amount of dollar flows to the country and spend its current dollars more wisely. The best way to boost foreign reserves or dollar inflows is through tourism receipts as well as foreign direct investment. I think now is a good time for the government to launch marketing campaigns to attract international tourists, especially due to the global economic slowdown. This is because Kenya could be perceived as an affordable holiday destination in terms of a global context. So in that case, the weaker shilling counts in its favor. Other than that, I think the government should implement investor-friendly incentives as well as policies. If Tanzania could do this and reap the benefits thereof in such a short amount of time, then I think Kenya can as well. But of course, there is a lot more that the government can do, but I think this is just a good start.
Well, it's been a pleasure hearing from you today, Shani. Thank you so much for joining us. That was Shani Smit-Lengton. She's economist at Economics, at Oxford Economics Africa, rather.